Hello learners, welcome to our session today. It is a continuation of what you were doing earlier on. Recall, it is a continuation of our revisions, and in our class today, I'll want us to handle question number 2. This is from our block model paper. Question number 2, specifically part C. And the concept in question number 2, I'll want us to understand the concept of thin capitalization in taxation. So this is a concept to do with thin capitalization. Thin capitalization. Thin capitalization. I know probably a person will ask, Mwalimu, kwani are we doing financial management in tax? You'll find that under this revised syllabus, and that's why I normally tend to insist a lot. For those students who will be doing your exams probably this coming December, it is very appropriate that you should update yourselves. I know majority of the students actually up to now, they wonder, what have we been studying? Some of them, they have been studying aspect to do with previous content, which, yes, some you share, but it is very good for you guys to be updated. And that's why we are here doing our revisions. So kindly make sure that you have everything updated so that you should not be messed up when it comes to your exams. So, thin capitalization, this concept is the same that we normally tend to use in financial management, whereby we are looking at a scenario of capital structure of a firm. Looking at this capital structure of a firm, you will find that in this case, what constitutes the capital structure, what will constitute the capital structure of the firm. We normally tend to talk about debt and equity. These are the components of capital structure of a firm. So in a scenario whereby our firm is financed with more debt than equity, and at this point, debt to equity ratio probably is a ratio of more than 3:1. So this is when we are going to term it as what? Thin capitalization. The firm is thinly capitalized, whereby the ratio of debt to equity is 3:1 and more, meaning that we financed our capital structure constitute of more of debt than equity. Basically, that's the concept of thin capitalization. So let us jump straight to this question number 2C, and see what we were required to do in that part. So these are our question. I'm sharing it on the screen so that all of us, you can see it. So this is what we are told, that Savannah Holdings Limited is a foreign control company operating in your country. The following information was extracted from the financial statements for the year ended 31st December 2020. Net fixed assets, net current assets, long-term loan, interest is at 12% per annum. Share capital I'm also given there. Profit for the year we also given. Accumulated loss brought forward, in that case I was given by the examiner. Then in addition to the same, this is what we are told. That justify the argument that the company was thinly capitalized. And part 2, compute the company's interest tax shield. So basically that is what you are required to do. So starting by number 1, we need to justify the argument that the company is thinly capitalized. Recall, anytime you are talking about thin capitalization, just as we had mentioned earlier on, my good students, we mentioned that a thinly capitalized company is a company whose debt to equity ratio is more than 3 times. This is what you are saying. Let me squeeze this question. Justify the argument that the company is thinly capitalized. Justify the argument that the company is thinly capitalized. And this is what Mwalimu is saying. Mwalimu is saying that a thinly capitalized company, thinly capitalized company, thinly capitalized company, thinly capitalized company, thinly capitalized company is a company whose debt to equity ratio is a company whose debt to equity ratio, whose debt to equity ratio, whose debt to equity ratio is more than 3 times, is more than 3 times, is more than 3 times. Meaning that debt is more than equity, and at least it should be more than 3 times. So what will debt constitute, my good students? At this point, I'm taking you as if you've never seen or you don't understand what debt is, right? So that you should grasp the concept very well. So debt will constitute the following debentures. Debt will constitute the following. In this case, we're talking of these are loans, debentures. Talk about the aspect to do with accounts payables. Accounts payables. Talk about accruals, etc, 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 etc. So that will also constitute debt. What about the aspect to do with? What about the aspect to do with equity? So equity will comprise of the following, of course. Equity will always comprise of, number 1, talk about the aspect to do with ordinary share, or rather term it as a share capital. Term it as a share capital. Talk about reserves. Talk about retained earnings. Retained earnings, etc, etc. So this is what will constitute equity, debt, or rather share capital, reserves, retained earnings, etc, 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 etc. So after looking at that case, talk of equity, come to a question in this case, because we are told to justify the argument that the company was thinly capitalized. Justify the argument that was thinly capitalized. We need to justify that the company was thinly capitalized. So if we are to look at our question, I want us to determine the ratio of debt to equity. Debt to equity ratio. What will we be having? So in this case, let us identify first of all our debt. In this case, debt, how much did we have? If you are to talk of our debt, look at just below the net current assets, you're having long-term loan, interest 12% per annum you're given. Debt, in this case, we had 5,000, which was a loan only. What about equity? For equity, in this case, we had equity to be share capital 400. Profit for the year 40. Accumulated loss brought forward. Remember, we are talking of retained earnings. So accumulated loss brought forward, I was given a loss of 10. So that should give us a figure of how much if we sum it up, my good students. If we sum it up, we are talking of 400 plus 40 minus 10. I'm getting a figure of 430. I'm having a figure of 430. So to do that case, what will be our debt to equity ratio? Therefore, our debt to equity ratio debt to equity ratio, debt to equity ratio, we should be talking of 5,000, which is our debt. We divide by 430. Remember our figures are in million, so that should give us 5,000 divided by 430. 5,000 divided by 430. That should give us 11.63. So it as if our debt to equity ratio, therefore, debt to equity ratio, we should be talking, I'm having 11 times more debt than equity. 11:1. I'm having 11 times more debt than equity. We do have 11 times more debt than equity. So therefore, we can confidently conclude that this company was thinly capitalized. This company was thinly capitalized by taking a look at that, whereby our debt is 11 times more than equity. So that is what you are required to do in part 1 of the question. Part 2 of the question, what were we asked, my good students? Part 2 of the question is still there. Compute the company's interest tax shield. Compute the company's interest tax shield. Compute the company's interest tax shield. Again, if you can recall what we did in our FM, the aspect of tax shield, the same concept now we are relating it in what? The same concept now we are relating it in finance, or rather in tax. The same concept we are relating it in tax. So therefore, how will we compute our interest tax shield? This is what you must always tend to have at the back of your mind, my good students. Anytime you are talking about interest tax shield, we normally tend to talk about our interest tax shield. Interest tax shield. Always recall the aspect to do with allowance interest. Allowance interest times the tax rate. Allowance interest times the tax rate. That should give us our interest tax shield. Allowance interest times the tax rate. That should give us our interest tax shield. So how will we go about our allowance interest? To determine our allowance interest, how will you determine your allowance interest? To determine your allowance interest, my good students, always remember that we'll always be taking our equity. We multiply by 3 because of the component of our thin capitalization in this context, times aspect of course, times the rate of interest, times rate of interest. That will give us our allowance interest. And at this point, this is an area that, again, you must be very good to know. Tax was revised, and we'll be looking at it on a more practical way. So that's why it will be very important for us to always be updated with things that have changed. So if probably you join us for revision and you've not been kind of going through the updated content, kindly, my good students, just make sure that if possible, you've communicated with Mwalimu. He will guide you, so that when it comes to exams, you should be very safe. You should be very, very safe. So looking at this case, first of all, before we determine our interest tax shield, let us compute our allowance interest. So allow me to use AI, not artificial intelligence, but allowance interest, not AI. You know, nowadays when you're talking about AI, everyone is all about artificial intelligence, right? Which is very good, by the way. So talk about allowance interest. Our equity, we've seen that our equity was 430. We multiply by 3 times the interest rate. What are you given as interest rate in our question? Just below here, we can see our question. Our interest rate, I was given a rate of 12%, being our interest, 0.12. That was our interest, right? That was our interest. So therefore, what will we be having? what will we be having? In this case, we should be talking for 30 by 3 by 0.12 to give us 154.8. 154.8. That is our allowance interest. Remember, this concept of interest tax shield in this form of allowance, or more so of allowance interest in this context, we are looking at a case whereby this company is thinly capitalized, where the company is thinly capitalized, right? So we're having our allowance interest. Can you now determine our interest tax shield? Our interest tax shield, ITS. Our interest tax shield therefore will be 154.8. We just multiply by our tax rate, which you are given 0.25, 25%. So by 0.25, that should give us 38.7 million. Of course, our figures are in millions. So that will be our interest tax shield. And that is what the examiner wanted you to determine in that question. That is what the examiner wanted you to determine in that question. So at that point, thank you so much, and let us meet in the next session. Thank you.